So today we're going to talk about just some general market issues we see going on. And I'll warn you, I'm probably going to nerd out a little bit today, but it will be encouraging. So let's go ahead and get started. And just as we get started, as always, this is our approach. Definitely heavy on asset allocation, light on security selection. As you know, anybody who's been on here before, asset allocation is what determines long-term performance variance. And then here, we've talked about this many times. This is the efficient frontier over here, and these are our portfolio groups, which we may touch on some today, but probably not as heavily as we have before. So let's dig right in. And the first thing I want to tell you is I have no idea what's going to happen in the financial markets in the short term. So if you got on the call to find that out, you might be disappointed. But as we've always said, I do think I know what's going to happen long term. And one of the reasons why the short term is so murky is this slide that I've got on your screen. If you can't see it, just holler at Sharon or send her a text in the chat box. But this is really indicative of what is going on in earnings estimates. We referenced that a couple of weeks ago, and just to make sure everybody's on the same page, earnings estimates typically are going to be guidance that companies will give when they issue current quarter estimates, which we're almost done with right now. But they'll also then we'll have folks like me and folks like investment professionals who will attempt to determine what earnings estimates are for a particular company. So what this shows is the dispersion or the difference in earnings estimates. You can see when times are normal, the dispersion is fairly low. That means they're within 10% of each other. In 08 and 09, nobody knew what in the hell was going on, and the dispersion or the difference in earnings estimates was very high. You can see when we go out to 20, this is 2000 to 20, you can see we're having a repeat of that. So when analysts try to determine what the heck is going to happen, particularly in the short term, they're really having a difficult time getting together on what earnings are going to be. And we'll talk briefly a little bit more about that, but it's highly unusual that there'll be that much difference or dispersion in earning estimates. And so that just reflects in the short term, there's a lot of disagreement among analysts over corporate earnings that spiked in March. That's a March number there. All right, this is kind of busy, but I think it's really good, and we're going to spend some time on this. I see you laughing at me, Sharon, because she hasn't seen this graph before. But I want to take some. Go ahead.
I just said good one.
Okay. I want to take some time with this one. This is the time axis down here. So this is as of March 18th or January 18th of 2018. So that's where these various indices as related by color bars were, okay? And we'll talk about all of them, but I want to focus on the S&P index. So at the 26th of 18, the S&P index was right here. So about 2 years and 4 months ago, okay? And that's the blue. So look at where the S&P index is right now as of May 5th, 2020, almost in the exact same spot. Now, as a reminder, what is the S&P index? The S&P index is the 500 largest U.S. stocks, cap weighted, that make that up. So that's going to be a lot of large cap companies, but we're basically flat over the last 2 years and 4 months. So we had this rise, and this was at about February 21st right here when we were setting records. Can everybody see my pointer, by the way? Sharon, can you see my pointer?
Yes.
Okay, great.
Yes.
This was the height. Then we had the fall off here, and we've recovered some, and we'll talk about why we've recovered some, why we think we have. But we're basically flat over the last 2 years and 4 months, okay? Doesn't feel like we're flat, but we are. And part of the reason it doesn't feel like we're flat is because of this run up that we had right here. I want to show a couple of other things on here too that I think are really important. The light blue or aqua is right here. So this is where the NASDAQ, which is a technology heavy index, is. That's going to be Amazon, Facebook, Alphabet, Google, those sorts of things. It started here, and I want you to look at where it got at the height on or about February 21st, way, 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 way up. It also had a drop, but it has had a net gain from here to here. So technology, the NASDAQ, has really pulled up some of the S&P 500 because it's actually had a net gain over the last 2 years and 4 months. Okay, so the NASDAQ and some of those technology stocks that we're all familiar with are some of what's giving a tailwind to this recovery that we've seen right here. I'll touch on a couple of others. Commodities, that's the purple here. Commodities are going to be things like oil. Well, we know from going to the gas pump, we had a bad beginning of the year, and it's just continued. There's been some volatility there, but commodities, driven in large part by oil, have really gone down over the last 2 years and 4 months. And then the others are transportation. You can see the green is transportation because nothing was getting shipped. It's making a nice recovery. And then the Russell is right here, which is mid and small caps. So the point of all this busyness and technological graph for y'all was I wanted to show you that we were flat. And there'll be a point to that here in a little bit. We're flat over the last 2 years and 4 months because we had such a large run up basically in 2019 from here to here. Okay. All right. So we talked before about what drives the U.S. economy, and the U.S. economy is 70% driven by consumer spending. Okay, 70% of what makes up the U.S. economy is driven by consumer spending. So as we talk about and you hear about unemployment numbers, this graphically shows you what has happened in some of these unemployment numbers. Okay, so construction, that's 2.4 million jobs lost in construction. Natural resources and mining, not so much. 1.5 million in manufacturing. Professional businesses, 1.1. What we're hearing a lot now is law firms, architectural firms, service firms who are driven by projects are also beginning to feel the pinch, and that would be there. Education and health services, that's about 1 million. Now, education, of course, colleges and schools are having to downsize, and I think that's only the beginning. Of course, health services would be extraneous, folks. But here's the big one that everybody's familiar with, and that's leisure and hospitality, restaurants, and so forth. When you can't go out to eat or you can't travel, they've lost 8.5 million jobs as of in April in leisure and hospitality. So more than the size of Atlanta has been laid off in leisure and hospitality. Moving on down, trade and transportation, information, financial activities, and other services. So the point of this was when we have this large of private employment declines, it's going to affect consumer spending. And as we talked about, and we'll touch on briefly, how quickly do we recover from that? That's the $64,000 question, because that will certainly drive consumer spending, which is going to drive consumer confidence. And I've got a little bit more information on that coming up. So far, so good? All right. So I thought this was a really interesting graph, and I think this is some good news. So now when we go out to eat, particularly in a place that we don't know where we're going, we'll search for restaurants and we'll search for ratings. And so that's what this is. This is daily searches for restaurants, and they have turned massively sharper just in the last weekend. Just right here, May 7th, this past weekend, searches by day have gone up. So what this begins to tell you is there's a lot of pent-up demand. I'm going to back up here for just a second. There's a lot of pent-up demand that's probably going to help some of these folks. How we do that, how that happens, nobody knows. But I think this is a beginning of a sprout of some optimism that people are, one, sick and tired of being stuck in their houses, and two, they're beginning to be able to go out and they're going to figure out where the heck they're going to go. And most importantly, they're going to spend money. That's the big deal here, is people are going to spend money in restaurants because there's still money in the economy, and a lot of money has been put in the economy by the U.S. government, and we'll talk briefly about that as well. So I thought that was somewhat optimistic. And then here's another one that I think is also kind of optimistic. I told you we'd have some optimistic views of things here. So this is the percentage of U.S. population under full stay-at-home orders statewide, okay? So as you can see, when it first started, there wasn't a whole lot. It moved up, it plateaued out. Here's where we are, here's where we were Monday, okay? But if you take what the states have said, assuming no big reoccurrence in places like New York or California or South Carolina and Georgia for that matter, this is what's going to happen to stay-at-home orders by May 27th and June 3rd. Not uncoincidentally, that's Memorial Day weekend right there. So if people don't get sick, I think we're going to have a massive explosion of money spending on or about this weekend, because I think there's a whole bunch of pent-up demand. And again, we don't know if this is factual, but this is the plan, assuming nothing happens. So in basically a March, April, May, in a 2.5 month period, we've gone from no stay-at-home orders to perhaps very small stay-at-home orders. Okay. So a couple notes, comments on where we are and what we're doing. We continue to favor cash over bonds. And what I mean by that, I've talked about that earlier, is interest rates are so low right now that it doesn't pay to get heavily into bonds. You should have some bond exposure, but as we look at folks who are coming into retirement, some are on this call, we look at what bonds are delivering, and right now the 10-year Treasury is still delivering about 0.6 or 0.7%, or $6 or $7 a year on a $1,000 investment. It just doesn't make sense, particularly when, as interest rates do rise at some point, bonds will be hurt temporarily. We don't need to go into the technicals of that, but we are using some bonds. We also continue to favor U.S. equity markets over international equities. We talked about that 2 weeks ago, and we continue to think that's the case. We think the United States, by all measures, will lead us out of a lot of this difficulties. I also think it's really interesting, many of you probably saw this, that on one of the Sunday news shows, Mnuchin let out a bomb that said there is evidence that this virus could have come from a lab in China. And he didn't say that lightly. And so tensions between China and the US have been frosty over the last few days. And I think that's probably a shift in United States approach to China and how they're going to deal with China, and probably try to make them the bad guy in this at some level. He wouldn't say it if there wasn't some evidence. I'm not a conspiracy theorist, but I just thought that was very interesting. The other thing I'll point out to you is Warren Buffett came out and had his virtual conference. And Warren Buffett has $128 billion in cash in Berkshire Hathaway, and they have elected not to make any buys. I think a couple of things are going on there. One, they have gotten too big to be stealthy in their purchases, but also I think he thinks this is different, and we've talked about the unknown somewhat, and they haven't had anything that's come to their door that has been a great deal, and I think that tells a lot about that approach, because as I mentioned before, he's under some pressure for not paying a dividend over the last 8 or 9 years, and he's sitting on an awful lot of cash that he could use to pay dividends. So I would keep my eye on what he does, and he'll also make some comments on Saturday that I'll probably be geeking out and watching, and if it probably will be interesting. He's a very smart guy. The other thing I want to touch on is based on earnings. We've referenced price earnings before. The market could be fairly valued right now. And what I mean by that is we're down, the Dow is down at 24, roughly a little below that as of today. But the earnings that are coming in, the price earnings, as we look at that, they are at historical levels or maybe even a little bit high. So what that means is, of course, earnings are low compared to prices, but we may be fairly to a little bit overvalued right now. So as we've talked about deals being out there, those deals based on earnings today are probably few and far between. Now, will earnings improve? That very well could be the case, but we don't know because we're in some uncharted territory. This is all about managing risk. Whether we're talking about what we're referencing here, whether we're talking about where deals are, where we're talking about what's undervalued or overvalued, it's all about managing your risk. So if you're a long-term investor with some cash sitting on the side, even if you think we're at equilibrium or the market is fairly priced right now based on earnings, that doesn't mean you couldn't invest for a 20-year time horizon. You could have done the same thing in December. So managing your risk is really important. And one other thing before we open it up for questions is I still think earnings reports in July are going to be really telling. As I mentioned in our last conference, we had 2 months that are being reported right now. The first quarter earnings for January, February, and March. A lot of them have come in early April, but that reflected 2 good months of January and February and 1 poor month of March. So I think July will have a good take on what earnings are looking like, but there'll be some salvos in the later part of this month and probably June as well to give some indication on what's going on. One final reminder, the strategies that I think are still in vogue are tax loss harvesting, long-term rebalancing, and Roth conversions. And we continue to err on the side of being comfortable, being a little bit cautious rather than accepting risk of jumping into the markets that right now could be fairly valued or could be somewhat overvalued. So with that, I will take some questions. Sharon, have you got any questions?
Well, we do, except for you pretty much answered it.
Okay.
And they even commented back that you had really answered it. It was about, what's your opinion on asset values and the market value, and to please comment on the equity and debt markets. And I think you've pretty much touched on those.
Well, I will comment a little bit more on the debt market and the equity market. So the debt market is just, we still favor quality, i.e. good bonds from companies with good balance sheets over chasing yield or chasing high interest rates. That's within the context of we prefer cash over bonds right now, which doesn't mean we're not in bonds, but you're just not being rewarded right now to tie your money up for 10 years on a U.S. Treasury bond and make $6. It just doesn't make sense. You can make 1 or 2 in a money market fund right now, probably more like 1, but you're not taking any risk and you can move out of that money. On the equity side, valuations, those are the key, and valuations right now are driven by earnings. I did see a couple that the GM reported, it was really bizarre. GM reported really good earnings today, relatively speaking, for car companies, but theirs was based on trucks. And that dovetails into a comment I made earlier is, where is some of this benefit going to come from? What's going to drive this market? Well, a lot of what's driving this market right now is certainly not earnings. It's all the liquidity and cash that have been put into people's pockets by the federal stimulus that have been the PPP and the small business loans and lots of things that are necessary to do. But if and when that dries up, that'll be a real test as to what's happening in the economy. And the balance, of course, is that dries up as the economy catches fire or just begins to gain some more traction.
You have another question. Is it still too early for financials or energy oil segment opportunities?
I don't know. If you're a long-term, in the short term, I think it is. I don't think energy is going to rebound anytime really soon. And I'm gonna cheat here and go back to one of these graphs, and I'll tell you why. All right, let's see here. There we go. So energy, here's the commodity, is in the purple here. And you can see energy was already struggling before we got into this situation, and it's just fallen off the cliff. So I think energy is going to take a while to come back. Financials less so, but again, if you're a long-term investor, you can't time the market. There's probably some value there. The question is, how long will it take for energy and financials to rebound? I don't know. That's a function of how, I think financials will rebound more rapidly than energy will. But if you're a long-term investor and the companies that you're looking at have a strong balance sheet, then it's probably a good long-term investment. I see a couple of notes on here. Is everybody hearing okay? Thank you. Okay. I guess I got that resolved. Let me see if I wrote down any other comments on here. They let me go rogue today and pick out my own graphs, and I didn't show it to anybody. So it's kind of like getting a car when you first got your license. Yeah, that's just going to continue. I guess I'll wrap up if we don't get any more questions. Is this going to continue? Are we going to be on an upward spike? I don't think we're going to. I think we're probably hitting some levels of resistance, and that's going to be based on what I talked about, the price earnings valuation of the market. We're getting to what's probably appropriate and maybe a little ahead of ourselves. As we're weaned off of some of this stimulus, will companies be able to produce earnings? We won't really know that because, as you can see in the first graph, earnings are all over the place. The estimates of earnings are everywhere. So I don't think we're on a trajectory back up to where we were, and we're probably going to continue to have some volatility. When we have some volatility, the person who asked the question about financials or oil, if you see a downturn there, that's probably a good time if you're a long-term investor to look at that. And a couple of companies, GM that I mentioned earlier, are cutting dividends and stopping buybacks. And that's not a bad practice. They're trying to conserve capital to get ready to weather the storm. And it would be irresponsible for some of those companies not to stop buybacks and conserve cash because then they can keep people employed. All right. Y'all always have good questions. I hope that this was somewhat helpful and not too technical today. I did think those graphs helped out a little bit. As always, we thank you for attending. After this, feel free to shoot us email or call us about any questions that we didn't cover here or that were not clear. We're always happy to help, and we're on call. And we wish you continued safety and good health. And remember, call on somebody you haven't seen in a while and just let them know you're thinking about them. Okay, everybody. Take care of yourselves and pass this along as you can. Bye-bye.